Hey, what's going on, my friends? In this video, we're going to take another updated look at our $25 a week dividend portfolio. Yes, we are contributing $25 a week into our dividend portfolio, where we started with $100 back on February 1st, 2021. And as you guys can see today, all time, we're currently sitting at $1,663.88. Our return is showing us over 12%, and our total gain currently today is at $121. Of that total gain, you can see our market gain, meaning the share price, the stock price, is $85.84. And what we are focused on, our earned dividends, is now, and I think it's been for a few weeks, but it's over what we are contributing on a daily or weekly basis. On a weekly basis. So our $25 that we're contributing on a weekly basis has now been surpassed by our earned dividends, which is $35.50. One of the newest features that M1 Finance rolled out is giving you the ability to have one tab, one page that shows you all of your earned dividends in a central location, which you can see the View Now button. So if you guys aren't using M1 Finance for your investing, especially long term, I would consider checking them out. I do have a link down below where you can use my link. If you sign up with them, add just what we added here, $100, you will be able to get free money. I think it's like $30. It might be up to $50 if you use my link signing up with M1 Finance down below in the description area. And so M1 Finance, I'm a big fan because of their ease of creating their pies, portfolios, and just adding a slice or a different company. So for example, we changed out AT&T. I said it last week. We were going to be selling AT&T. I've been saying it for a while, kind of kicking the can down the street. I pulled back a bit, and then with some latest news, you can check out last week's dividend video. We decided to pull the plug on AT&T, and we got a new company in the mix that I think I may do it in this video. I was thinking of making a separate video talking about the new company, but maybe we'll just have it be an ongoing extension of this video. So you're going to see who that new company is when we look at our earned dividends, if they happen to pay anything, which nope, they didn't, because it's not paying on a daily basis. It's not paying on a weekly basis. However, they may be paying on a monthly basis, definitely a quarter at the least. But being that it's a REIT, I think it is a monthly basis. So as you guys can see, our Newt stock is killing it with $8.84 that we've received in earned dividends from Newt. After them, it drops, cuts in a half, goes down to Verizon, which is $4.15, and then another REIT, which is Realty Income, at $3, and then so on and so on. So, I mean, as you guys can see, Newt has been performing really, really well. It is a REIT, so we expect REITs to, push out the dividends, hence us having another REIT in here. And that is actually the newest company that we decided to add to our portfolio, a new REIT. But it's unique. And I wanted to have something where we can also kind of hit the growth side of things a tad bit, slightly, potentially, right? So let's see how we're doing when we look at the past day first. The past day, you can see we're up 0.33 cents. The past week, we're up 2%. The past month, we're up 3%. The past quarter, we're down, or no, we're about even pretty much. And then 1 year or all time, you can see our returns is 12.10%. So again, if you're someone new and you're just jumping in here, you decide to create a dividend portfolio and you aren't seeing great numbers like 12%, 7%, 10, 15, 20%, 8%, whatever it might be. If it's only 33%, remember, this is short term, right? We're in this for the long haul. This dividend portfolio is not something we are expecting to get rich off of overnight. We are building up our wealth with this portfolio. Maybe we're using this as a down payment for a house in 5 years or, 10 years, 3 years, whatever it might be. Having some sort of long-term goal where this money is going to help go towards it will help give you a little more motivation, a little more encouragement when times are slow, when times are down, because hey, the stock market does not only go up, it does go down as well. And so we have to be consistent we have to be willing to, make sacrifices. Maybe you get a little bonus, you get a little extra cash, or you paid off a bill and you never have to pay that again. That means you have extra money there. Don't use that to start splurging and balling out. Use that towards your dividend portfolio. Use that towards some sort of investment tool that will allow you to grow your money. So let's scroll down and see how we are doing. And we'll also see who our new company is. So we'll pull this over here, come down, and you guys can see. Some of you can probably see who the new company is already. But when you look, you can see our REIT, Newt, is at the top with a 44.14%. Then you have Pepsi, which I think this might be the first time Pepsi's been this high. Seeing them at 24.64%. And then we have our other REIT, Realty Income Corp, at 24.26%. Then JP Morgan Chase at 22.23%. Then Coca-Cola at 9.58%. Procter and Gamble at 9.56%. And then we have our new baby, our new company in the mix, IIPR, Innovative Industrial Properties. And they are coming in at 8.16%. So the new dog is already on fire, right? Now, AT&T was the company we had in here, and they were pretty much always in the red. Go back and look at previous videos, and you will see AT&T generally was at the bottom when it came to their actual gains and returns. However, AT&T did perform well with the actual dividend payout, the earned dividends. AT&T generally was second, right behind our Newt REIT. So AT&T was paying out a nice, good, solid dividend. However, we know their changes that they are going to be implementing over the next year or so does mean a dividend cut. So we wouldn't be continuing to receive those nice, large amounts of earned dividends from them. It was only going to get, reduced essentially, and bring us less dividends. But their growth side, the stock probably would have, the return we would have seen here probably would have gone up a bit. But, that's not certain. We know the dividend cuts was coming. That said, and because of some other latest news, again, check out the last week's dividend video that says where we sold AT&T if you want some more clarification as to why we decided to sell them. But we decided to add IIPR to replace AT&T. And like I said, they're already performing well. And we'll dive into a little bit more of who IIPR is in a moment. But finishing up our update, you can see Johnson & Johnson is right behind them at 3.82%. Huge jump, right? Huge jump. And then we get into the red, we get into the negative, where 3M and Verizon Communications are both around 3 and 350%, negative 3 and 350%. So, it's first thing in the morning. I mean, it's like 6 o'clock. It's like 6:30 Sunday morning. And I decided when I was doing my research on who we would replace with AT&T, I had a few different ideas. Wasn't entirely sure of the direction I wanted to go, but I came across IIPR, and this is actually the first time. I don't think I've even really been familiar with them in the past. And, you can see down here, market cap of 6.2 billion, a PE ratio of 66.1, and dividend yield is 2%, a little over 2%. Now, some people would probably want to, might want to see a higher dividend yield. I mean, you have to have a balance. And considering, if we go back really quickly and we look at like Newt, we can see Newt has a dividend yield of 8.3%. Their PE ratio is 10. I mean, big difference, right? Major difference, but they're on completely opposite sides of the spectrum, which I believe will help give a sense of balance, especially since IIPR is a REIT. Yes, it is a REIT. Let's jump into this article really quickly and get a little insight. This came out yesterday. So I made the move with IIPR last week. And, you can see they were actually added to the portfolio on the 18th, which I believe the 18th was, well, what's today's date? Today's the 24th. So 18th was around what, like Tuesday or something, right? Monday. So I made the move like almost exactly a week ago. And I wish I made, yeah, after basically after the last AT&T video we sold AT&T, and that Monday morning, maybe afternoon or whatever, we made this adjustment where we added innovative industrial properties, and it's been running since. That was in here. We got in here at 157.64, and it's running. We're already up to 170. I mean, if we had some money behind them and we had a stock, we bought, a stock, a bunch of stocks or an option, did a call option, we would be up nice right now. So far it's looking like a good move, but let's find this little article. This just came out a few days ago, after I made the move, but it says the pot stock in buy zone is a double threat after 547% run. So Innovative Industrial Properties, IIPR, is the IBD 50 stocks to watch pick for Thursday, as it sits in a new buy zone following a 547% run from its 2020 lows. Again, I came across this article after the fact. I can't remember what few articles what sources I was reading and really heavily dependent on when I decided to make the move and add them to our portfolio. But when I came across this morning, I thought this was good to give us a quick little, kind of glimpse of who they are and how they're performing and why I decided to add them into our portfolio. So real estate investment trusts are not usually favored by growth stock investors, but Innovative Industrial is unique. It focuses on the marijuana industry. It focuses on the marijuana industry, serving growers by providing them with land. The firm had 73 properties across 18 states at the end of the second quarter. This represents about 6.8 million square feet. It follows a business model that frees real estate-focused companies from the usual federal corporate taxes, so long as they return their free operating cash flow to investors in the form of a dividend. Investors in IIPR stock thus get a double benefit: its rapid rising dividend and price performance. The company's annualized yield currently comes in at a 2.5%. This is almost twice the S&P 500 average yield of 1.3%. Its dividend has jumped from 15 cents per share in Q3 of 2017 to $1.50 per share in the third quarter of 2021. The company, in fact, raised its dividends each of the past 6 quarters. This is money. Now, yes, REITs are very volatile, and so are cannabis companies. So this is kind of, yes, it said it's like a double, what do they call it? A double benefit, but it also has that double whammy against it as well. But I do believe, and I am confident, that as cannabis regulations continue to move forward, we will see companies like this that are focused on the cannabis industry continue to perform well too. Being that they are in a unique niche where they're targeting REITs, they're targeting real estate, but specifically within that industry, I think it's a gold mine. I think, real estate is obviously hot, and the cannabis industry, again, it's very volatile, but as a whole, it's harder than what it was 10 years ago, right? 20 years ago. If you would have asked someone 20 years ago, is cannabis going to be legalized in America? They would have been like, keep dreaming. Ask someone that today, they'll say, after my dream, when I wake up, now my dream is at the end and I'm about to wake up soon. We see the light at the end of the tunnel. They're kicking the can down the street. You still got a bunch of very heavily, this isn't to get into politics, but very heavily conservative based states that are still fighting it, putting up a lot of resistance. But we're making progress as we continue to debunk myths and the BS and help with getting more research done on it to help, again, show and prove lot of the crazy nonsense that was said around reefer madness back in the 30s and 20s and 50s and 60s that kind of has been lingering on. And occasionally, over the past 20 years, you'll hear a certain individuals in a certain party tend to use arguments that are BS as excuses as to why it should still be held down and legalized and made illegal and things of that sort. But the opportunity to get in with something like this before it really takes off now is huge. And this is really we're at like a kind of that crossroad, right? The fork in the road or the crossroad, whatever you want to call it, where things are about to turn. And if you're on board now before it takes off, you're not going to really miss the wave, right? That's the key. And I think us adding this into our dividend portfolio will help us with benefiting from that curve. When things start to curve and take off, we are on it. We're going to get that slingshot. It's not going to be, we're trying to jump on it, and we might miss it, or it's still in the volatile phase though. So I'm saying that with the cautionary warning if you do decide to add them to your portfolio. But I mean, you guys saw those numbers. You heard some of these numbers, and the company's annualized yield currently comes in at 2.5%, which is twice as high as the S&P's 500 average yield, but not remotely close to as high as our Newt dividend, which again, as you saw, Newt, that's our highest paid dividend stock, and it's performing best in terms of its actual return on its stock, on its share price. It's even at the top of the ladder here. That is a nice situation to be in, where we're seeing it performing the best there, but it's also paying out the most dividends. That's what you want. We want to see more companies that can perform well when it comes to their share price and giving us high returns, but also paying us consistent, reliable, and seeing an increase of dividends, which that's what we are seeing with IIPR over the past, what do they say, 7 quarters? They've been seeing an increase in their dividend payouts. So, I mean, these are all good signs. That doesn't mean they might stop, or there it is. It says raise its dividend each of its past 6 quarters. That doesn't mean things might, get halted a bit. They might have to decrease it. They might have to keep it stagnant for a bit. But again, it's still comforting to see that, hey, during the past 6 quarters when we were in a lockdown, this, that, and the other, they were able to continue to perform well and generate good numbers and continue to increase, not just be stagnant, not prevent it from going down, but increase their dividend payout. That is what we want to see. And, we could dive more into some of the benefits as to why I believe IIPR is a good move. But I'm curious to hear what you guys think. And if you are familiar with them, or maybe you're not, and this is the first time you're hearing about this company that focuses on cannabis real estate, maybe, you're like, hey, that's actually a really great idea. Or maybe you see some red flags. Let us know down below in the comment section. I would love to hear what you guys think about this latest adjustment to our portfolio. Do you think it was a good move? Do you think it was a bad move? I mean, us doing that single move, I'm pretty certain, I can't remember exactly what it was a week ago, but I'm pretty certain that did help to change these numbers that you're seeing here, because AT&T, again, was not performing the best. It was not too hot, and we know they were only going to make cuts on their dividends. So even our earned dividends that we were seeing them performing well on, that was only going to be reduced as well too. So let me know what you guys think. Feel free to comment down below. Much appreciation for watching. And I also want to give you guys a quick little heads up. I got to figure out a day of the week I'm going to roll out our growth portfolio. So I just made a brand new growth portfolio that focuses on, kind of startups and growth companies. I'm anxious to see what you guys think about that portfolio. A few of you have kind of been wanting to see some, aren't really interested in dividends, but do want to start off or do want to grow a portfolio that focuses on the growth side of things. So I'm hoping that portfolio does perform as well, if not better, than what we're currently doing over here with our dividend portfolio. So look out for that. Definitely subscribe to the channel. And as you guys can see, I finally have started to be consistently rolling out new content to help you on your financial independence journey as you strive for financial freedom. And to me, in my eyes, one of the most important things that I did that helped me with moving forward was, well, it happened after I was let go from my sales job, and that was starting my own business, or at least really, jumping back into the self-employed world, the gig economy, so to speak, and doing my own thing. And that's not for everyone, but for some of us, it really is. And some of you will do much better doing your own thing than being part of a established organization, a company, especially a place in which you don't feel like you are being valued and respected and wanted. So for me, that was one of the best things that kind of happened to me, and part of the reason I'm starting to share so much content with you guys to help you on your journey as you move forward in life as well. So, like I said, if you haven't yet, subscribe to the channel, because I do have a lot more content that I will be rolling out every day, and been rolling out a lot more content aside from our dividend portfolio videos too. So, like I said, definitely head over to makemanagegrowmoney.com, or just, subscribe to the channel here on YouTube, and you'll at least be up to date on all of our latest videos. And also, I did roll out our second course on the website, which is our Elite Tasker TaskRabbit Playbook. Oh yes, you can make some bread on TaskRabbit, I'm telling you. But all right, my friends, if you haven't yet, like I said, like this video, subscribe to the channel. But you already know I got to keep it moving. But I'll see you in the next video. Peace.